Welcome back everyone, I hope you're having a great day, and in this video we're going to take a look at 3 Dividend Kings that may be a great buy right now. Dividend Kings are the amazing companies that have been paying out a growing dividend for over 50 consecutive years. Not only have they been paying out capital to their shareholders for 50 straight years, which is already very impressive, each and every year they've been growing that annual dividend payment, so as a shareholder in a Dividend King, you're receiving more and more passive income every single year. So in this video, we're going to take a look at 3 different companies who've all achieved the status of a Dividend King, and we're going to go over the company's current fundamentals, go over their revenue growth, take a look at their dividend and their dividend safety, and overall I'm going to give you a quick overview of 3 different Dividend Kings that may make a nice addition to your personal stock portfolio that are currently trading below their estimated fair value. But before we do that, I am going to ask you to please hit that like button and subscribe. I'm the Gen Z Investor, and on this channel we talk about the stock market, I talk about different dividend paying companies, and of course I track the progress of my own stock portfolio that you can see currently sits at a value of $158,000. We did have a good day in the market yesterday, up 2.5% or $3,803, and overall my portfolio is up around $22,000 or 17.2%. But as we also know, 2022 has not been a very good year for the stock market. Overall, the S&P 500 is down close to 21% on the year-to-date chart, and this major pullback in the market has allowed these Dividend Kings to now fall to a much more attractive level, and they're all currently trading below their estimated fair value at their current share price. So now if we jump into the first company we're going to go over in this video, it is ticker PG or Procter Gamble. They currently trade for $130 per share, and on the 1-year chart they are down just over 6%. But if we take a look at the 52-week range, they are trading right near the 52-week low. They currently have a forward PE ratio of 21.7, a dividend yield of 2.85%, and this is a massive company with a current market cap just above $300 billion. But if we take a look at the recent price movement, from a high of around $163 per share, they have now fallen over 21% in just the past few months. So they've seen a major pullback as of late, which has driven the share price down to a very attractive level. And if we take a look at a report from Morningstar, they estimate the current fair value for Procter Gamble stock to be at around $132 per share. So at their current level, you can pick up Procter Gamble at a slight discount to their current estimated fair value. And like the great Warren Buffett has stated, it's better to buy an excellent company at a fair price than a fair company at an excellent price. And Procter Gamble is the definition of an excellent company. They operate a widely diversified product mix and own market-leading brands in every consumer category that they operate within. Procter Gamble focuses on 10 different areas of the consumer sector, and we can see household names that people use every single day. These products are known all throughout North America and are sold all around the world. Procter Gamble is one of the largest diversified product mixes amongst the consumer categories, and at this current point in time, for such a high value company, they're actually trading with a much more attractive PE ratio relative to their current peers. Clorox, Colgate, Church & Dwight, and Kimberly-Clark are all trading at a higher multiple compared to Procter Gamble at this current point in time. So you can buy this nicely diversified company that's one of the best leaders in the consumer sector for a lower valuation than its peers at their current share price. And if we jump over to the company's income statement, year after year, they continue to deliver great results. We can see that Procter & Gamble has been able to expand their total revenue from $66.8 billion back in 2018 up to $67, then $70, $76, and now up to over $80 billion of total sales in the trailing 12 months. So for a company as large as Procter & Gamble to already achieve massive scale and still have the ability to actually continue to grow sales year after year, that just shows how much of a beast this company really is. And if we take a look at their latest investor presentation, they're not solely focused on only one category of their business. Through Q3 of 2022, they saw organic sales growth in all 10 of their product categories. All 10 of the company's current categories saw organic sales growth, which is absolutely incredible to think of. Of course, some categories saw rapid expansion compared to others, but this company is growing organic sales year after year throughout its entire product mix. That shows how well diversified and how strong the name brands really are, that this company's future is not solely reliant on only 1 or 2 brands, but of course the massive diversified line of goods that they currently operate within. And these growing sales has led to massive capital being returned to the shareholder. Of course, we're going to talk about the dividend because this is a Dividend King and that's the focus of this video, but Procter & Gamble has done a great job of actually buying back their shares over the past few decades. Back in 2009, the company had over 3.1 billion shares outstanding, but we can see year after year they continue to buy back their own stock, reducing the outstanding shares, and now around 2.5 billion shares are outstanding as of the latest quarter. So as the company continues to buy back more stock, each share you own in your personal portfolio becomes a larger chunk of the overall company. And now we're going to move on into the company's dividend history and take a look at their current dividend info. They have a yield right now after the latest decline in price of 2.85%. They pay out $3.65 per share going forward, with a payout ratio of around 60%, which I believe to be very safe and very conservative for this consumer giant. They pay out a growing dividend, and the 5-year CAGR is at 5.58%. I would call that mid-tier in terms of dividend growth. It's not on the slower end, which some companies grow at only 1 to 2% per year. It's not at the 8 to 10%, which I would consider very high. So a nice mid-tier dividend growth rate from this consumer beast, and they have a 65-year streak of continuous dividend growth. Meaning through every recession and depression we've seen in the past 65 years, Procter Gamble has not only paid out their dividend, but they've actually increased it through those tough times. And if we take a look at the dividend safety score, it comes in at the highest rating possible of a 99, which is considered very safe. So overall, this means it's very unlikely that we see a dividend cut from Procter Gamble in the near-term future, and I do believe over the long term, PG will continue to pay out a growing dividend for the next few decades going forward. So overall, Procter & Gamble was stock number 1. It was the first Dividend King to take a look at after the recent decline in share price. It's fallen over 20% from its high and currently sits slightly below the estimated fair value according to Morningstar. So now we're going to move on into stock number 2, and that is ticker TGT, which is Target, one of the largest, most popular retail companies in North America. They currently trade for $156 per share, and we can see on the 1-year chart, they are down close to 33% overall. And another company that trades on the low end of the 52-week range. Their current forward PE ratio comes in at 18.4, which is just slightly above the overall average for the S&P 500. They have a dividend yield at 2.9% and a current market cap just above $68 billion. And if we take a look at the Morningstar report for Target, they estimate the fair value per share for this company at $195. So that shows significant upside from the current share price. And right now they believe Target is around 20% discount from the estimated fair value at this current level. So Target is a fast growing company. Of course, the 1-year chart does look pretty bad, but if we zoom out, over the past 5 years, even including the most recent decline, the company has seen share price appreciation of over 168%, and that does not even include the dividends reinvested that you receive every single quarter. So this company continues to grow. The share price performance over the long term has been incredible, and I do believe going forward they will rebound, continue to grow, and the share price will see some significant upside from the current level we're at right now. And if we take a look at the income statement, that's shown in the numbers. Total revenue has been expanding year after year. 72 billion up to 75, 78, then a significant jump up to 93 billion, 106, and in the trailing 12 months, they've generated just under $108 billion of total sales. So overall, Target continues to expand their revenue. Year after year for the past 5 years, they've seen significant revenue growth, and over the longer term, the share price has seen some incredible performance. So like I've mentioned, you want to buy the good companies, the strong dividend-paying brands, when they see a decline in share price. You don't want to buy them at all-time highs. You want to buy the dip and hopefully get those gains as the companies continue to expand and grow over the longer term. And now taking a look at Target's dividend scorecard, we can see they have a current yield at 2.85%. They pay out $4.32 per year per share, with a payout ratio at around 41% overall, which is on the low side and is very safe and very conservative. And they are a fast dividend grower with a 5-year CAGR at 9.3%, with the current dividend growth streak of 53 consecutive years. So of course, a dividend king with some nice consistent fast dividend growth. And overall, the dividend is considered very safe, coming in at a dividend safety score of 90. So overall, it's very unlikely that we see a dividend cut coming from Target anytime soon. And of course, just this year in June 2022, they grew their dividend by 20%, which was a very fast dividend increase and above their 5-year dividend CAGR. So even this well-established brand can still post some very nice dividend growth for all the dividend investors to receive. So Target was company number 2 of Dividend Kings to keep on your watch list right now. And now as we move on into stock number 3, it'll be ticker LOW, which is Lowe's, one of the leaders in the consumer hardware space, currently trading for $197 per share. And over the past 12 months, the company is down 5% and of course is trading on the low end of the 52-week range. And as you can see, a general theme throughout the video is I'm showing you companies who are currently down. I'm not going to show you companies who are trading at 52-week highs, setting new records day in and day out. I want to show you the companies who have strong fundamentals, who have been beating up as of late, and it might be a nice time to buy when they're trading at a discount relative to the estimated fair value. We can see that Lowe's currently trades with a forward PE ratio of only 13.9, a nice low dividend yield at 2.24%, and a current market cap right around $116 billion. But if we take a look at the share price movement over the past 12 months, they reached a high at around $260 and have fallen around 24% down to their current level. So it may be a nice time to buy this big consumer giant over a major pullback. And taking a look at the Morningstar report, the estimated fair value per share is at $217, representing around a 13% discount at their current level. So Lowe's is again similar to Target, trading significantly below the estimated fair value according to Morningstar, meaning now may be a great time to add the company to a watch list and keep an eye on them going forward. If we jump over to the company's fundamentals, we can see the company continues to grow revenue year in and year out, 68 billion up to 71, 72, 89, and then over 96 billion in total sales in 2022. And if we jump over to their cash flow statement, their cash flows from operations continue to trend in the right direction, up from 5 billion back in 2018 to around 9 to 10 billion over the past few years. And similar to the other companies we've already discussed, Lowe's does a great job of buying back stock every single year. So although you are getting a dividend raise along with some fast dividend growth and share price appreciation, your shares are also becoming more valuable. 1.4 billion shares outstanding back in 2009 that has shrunk to only 639 million shares as of the latest quarter. So they've cut their outstanding shares in half over the past decade and a few extra years, which is absolutely insane. And if we take a look at the company's share price performance over the longer term, they're up 140% over the past 5 years. That doesn't even include the dividends. Absolutely insane performance from one of the leaders in the hardware consumer sector. And now if we take a look at that dividend, a yield of 2.17%, which may be on the low side starting out, but this company does a great job of actually growing that payout very rapidly year in and year out. Their payout ratio is at a minimum of 27%, which is extremely safe, extremely sustainable, and allows the company to actually grow that dividend at a fast rate because they have excess earnings to reinvest back into the business to grow earnings going forward, but also gives them enough room to continue to grow that dividend at a very significant rate. And we can see the 5-year CAGR is at 18.77%. That's extremely fast dividend growth. Some of the largest tech companies that pay a dividend don't even grow their dividend at such a rate over the same time period. And we can see the dividend growth is now sitting at a 58-year streak, which again, extremely impressive. The company's been able to weather through any storm and continue to pay out that growing dividend. And they currently sit with a very safe rating coming in at 93. And we can see back in May 2022, they grew their dividend by 31% in a single year, which is absolutely remarkable overall. So Lowe's is the third dividend king to keep an eye on for your portfolio. In this video, we took a look at 3 different brands. We went over Procter Gamble, we took a look at Target, and then of course we finally wrapped it up with Lowe's. Those are 3 very strong dividend growth companies with streaks of growing their dividend for over 50 consecutive years. If you like the video, if you like the analysis and you like the ideas of companies to keep your eye on, please hit that like button down below, subscribe to the channel for future videos, and I will see you in the next video coming out very soon. Thanks for watching.